Welcome to the From Lab to Patient, Garage to Market podcast with your host, Phil Crowley. In each episode, we will discuss professionals serving the tech startup market and the various issues of importance to those companies. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, crowleylawllc.com. Now here's the host of From Lab to Patient, Garage to Market, Phil Crowley.
Welcome, and thanks for tuning in to our podcast. We tend to focus on those people who provide services to startups in the technology and life sciences space to give entrepreneurs and companies and their managements an opportunity to learn from people who are on the front lines some of the key issues of which they need to be aware in order to be successful. Today, I'm happy to have with me John Pennett, who's a partner in the international CPA, accounting, tax, and business advising firm of EisnerAmper, and has a great deal of experience in these issues. John, thanks for joining us today.
Thanks, Phil. Thanks for having me. I appreciate having the opportunity to speak with you today.
Well, John, can you give our audience a bit of a view of what EisnerAmper is and what your role is with EisnerAmper?
Sure, and I'll do it in the perspective of an elevator pitch, and so that's how I always tell our entrepreneurs to keep things short and to the point. So we're about a 75-year-old accounting firm, but about 3 years ago, we went under a major transformation event. So we took on a private equity investor, and like most private equity investors, they gave us some money and the mandate to grow significantly. So we have added 17 acquisitions in the last 3 years. So we've grown to over 4,500 employees and 30 some odd offices around the country. We've broken ourselves into several key business units: tax, audit, outsourced services, consultative services, and wealth management. My role with the firm is I'm part of the outsourced services group, and we help support entrepreneurs throughout their process. And I lead our technology and life sciences industry group. So that's a practice of about 6,000 clients, ranging in size from embryonic startup all the way through venture-backed, private equity-backed, and then through their M&A or their IPO transaction. So the common thread is that entrepreneurial journey, going from where you are to where you want to be.
Oh, that's fantastic, John. And I'm sure you have some great stories to tell about the process. It seems to me that the services that EisnerAmper renders for companies is extremely important, because if you don't have good financing controls and metrics, it's really hard to run a company and hard to be successful and hard to stay in business without running out of money. What do you see in your practice as some of the key issues that come up when you are initially addressing the needs of, let's say, a startup company? What are the sorts of things that they really need that they may not appreciate?
So there's a few things. So you start off with, what type of entity do you want to be? Do you want to be a pass-through entity like an LLC, or do you want to be a corporation? And that usually depends on how you're going to be financed over the long term and what you think the exit may look like. We then are given lots of questions about ownership. So I'd like to give ownership to some of my key stakeholders and co-founders and key partners and things like that. How do I do that in an efficient manner and strategic manner? So that becomes very important. And then, of course, you always get the questions about sort of, just being a good corporate citizen and being in compliance with rules and regulations and the like. That's sort of more of, I kind of look at it as an output. To me, one of the key things is to really think about and having command and control of your budget, right? So what do you need to accomplish? How much money do you need to accomplish it? What will you accomplish it? Can you build credibility by doing it and staying on time, on budget? Those types of things are super, super important. So, of course, every company is different, but those are kind of a couple common things we see throughout.
Well, it seems to me that when you're trying to attract investors, having a system in place like the ones that you help your clients put in place can be a factor that really facilitates financing because then the investor has a feeling that the management is in control. Being in control as well must involve some sort of tax planning. And I know there are myriad issues surrounding federal, state, local tax issues. Which are the ones that you find that can be most important for startups or problematical for them?
So there's a couple of topics that are really recurring nature. So one of them gets back to that choice of entity type, and if you're a C corporation, can we qualify for the qualified small business stock exemption, the QSBS or the Internal Revenue Code Section 1202 qualification, which could give you a nice break from capital gains if you sell the company. It's got restrictions, of course. You have to be able to follow those. But for a company to think about whether they will be QSBS eligible is a really important topic. So that's certainly one thing that becomes critical right from the start.
John,
Another,
can I ask you to do a little bit deeper dive on that? Because I think that many of our viewers are not familiar with qualified small business stock in Section 1202. And it's a real advantage if a company qualifies.
absolutely. So it has to be a C corporation. You have to be the original purchaser of the stock, so it can't be purchased in a secondary market. Um, You have to hold on to the stock for 5 years, and then the company must be sold in a single transaction. So it can't be an asset sale or an out license of technology. You have to sell the company. And if you qualify, and the code section goes on for pages and pages, so we're digesting this into 3 sentences. But
Yeah.
if you qualify with all the caveats, of course, you could potentially get up to $10 million of capital gains tax free. So it's a very, very important opportunity for investors. That's why we see most times angel investors, seed investors, venture capitalists always want to invest in a C corporation, not in an LLC, because they can take advantage of that tax attribute. Super important.
So that only applies to C corporations. If you set up a limited liability company or some other kind of entity, that fantastic tax benefit is not available, right?
Correct. Correct. It still may make sense to do that if certain likely outcomes are going to happen. Like if you believe that you may likely sell an asset out of the company for a lot of money and just sell an asset. It may make sense to be a pass-through entity, but that's where getting professional advice from your attorneys and your accountants and doing some modeling, is really pays off in the long run. So you can make a well-informed decision. Of course, nobody knows what the future will hold, but you want to at least have gone through the analyses and make that decision informed as best you can.
Well, there are other tax provisions that impact startups and, excuse me, founders. I hear people talking about Section 83B elections. Can you tell us a little bit about that?
Sure, sure. So an 83B election is used when a recipient gets restricted stock. So typically, when there's other investors involved with a company, they like to see that the founders are going to earn their stock over time. So say over 2 or 3 year vesting period. That's what's called a restricted stock because it's earned over time. Um, Investors like that because it provides the best opportunity to ensure that the founders or the recipients of that stock are rowing in the same direction as the investors are. So
Mhm.
we're all aligned together to get the greatest benefit that we can. So we're all looking for that long term capital gain, if you would. So with the 83, so by receiving stock, you have created a taxable income event for the recipient. So you've received something for free or something that's undervalued. So you have a taxable event. So what 83B allows you to do is to pay all the tax on the fair value of all the shares regardless of when or if they ever will become vested, at today's value. You have a very short window of time, 30 days, to decide whether you're going to do this or not. So if you think about a startup and you could say today's value is, let's say, a penny a share, you might say, I'll take the chance on paying the tax at a penny a share. I'll pay the tax on that today because it's not very much money, and not worry about it when they vest. The alternative, if you don't file the 83B, is that when the shares vest, then you pay tax on the fair value at that date. So if you have a 4-year vesting, and let's say some of those shares vest at the end of 4 years, and instead of being worth a penny, they're worth $10. Now you have $10 worth of tax to pay.
Right.
So it's a big difference. So for people who, so we see restricted stock used a lot for sort of C-level and upper management. So people who have enough money to pay tax. And usually they'll say, if they're a believer in the company, which hopefully they are since they just joined,
Yeah.
that's typically when these grants occur. If you're a believer that the stock value is going to go up and you can afford to pay the tax today, most of the time they'll file the 83B election and pay that tax today and avoid that upside down the road.
Mhm.
And it also at the same time, starts that 5-year clock for the qualified small business stock exemption as well.
Right. So there's a double benefit there if
Mhm.
you believe in the company. And of
Yep.
course, many of the clients with whom we work are starting out with kind of a greenfields company where there are no assets in the company. And so the amount of value to take into income is virtually zero at that
Yep.
particular point in time. So it's a great
Right.
deal for founders to make that 83B election, particularly if they deal with a venture capital firm that requires some type of vesting, or through prudent planning, they require vesting for individuals who are going to be hopefully working in the business.
Yeah, I serve as as an advisor for a friend of mine's business, and I got some restricted shares, a very tiny percentage of the company,
Mhm.
and I was asked if I wanted to file an 83B, and I think the dollar amount was $3.35. So I said sure, I'll pay the tax on that today.
That's great, John. What about other federal tax incentives for things like research and other issues like that? Are there any substantial things that startup entrepreneurs should know about?
So definitely on the R&D side, there's a couple things to think about. So many states have a particular program where they provide some sort of benefit packages, whether it's in the form of grants or tax credits or things like that. So whatever state you're located in, you should definitely connect with attorneys, accountants, the economic development authorities in those particular states. Find out what's potentially available, and take advantage of that when you can. For federal purposes, there is an R&D tax credit that was put in place. There's an R&D code section that was put in place 75 years ago. Um, that R&D credit, that R&D deduction has unfortunately sunsetted, but is due to be reinstated very shortly, assuming that our legislative branches can finish their activities and get some of these bills signed, which of course we know has been problematic for a long period of time. The anticipation is that all these R&D costs will be deductible retroactively, but that has not yet happened. But in the meantime, there is a terrific R&D tax credit that is available. So roughly 6%, there's different categories and different rates, but roughly 6% of spend on domestic R&D costs for qualified projects could qualify for that R&D credit. So if you spend $100, you would get $6 in an R&D credit. You can use that R&D credit in two manners. You can wait until you have taxable income, in which case you have essentially prepaid $6 towards your taxes due,
Mhm.
or you could use those credits today as a monetized item and work with your payroll provider to offset the FICA match that you pay when you pay your employees. So there's a 7.65% FICA match. Again, all these things have some rules and restrictions, but this is sort of the
Right.
general rule. So when you pay your payroll, the company matches 7.65%. You can use that $6 in that example as sort of like a debit card and apply that debit card against that 7.65% too. So there's some limitations and things like that, of course, but it is a great way for very early stage companies to monetize an asset that would otherwise be unused until you have an exit event.
Super, John. Well, I think that underscores the importance for even early stage startup companies to have a discussion with the folks who are experienced in these tax issues to make sure that they're maximizing the impact of all of the work they're doing. And as I like to say to my clients, it's not how much money you make, it's how much money you keep. And so adequate tax planning is certainly very important. I'd like to take just a moment here to acquaint our viewers with Crowley Law, our law firm. We're a boutique law firm that is passionate about helping life sciences and other technology entrepreneurs realize their dreams, to take great ideas from the laboratory bench to the patient's bedside, or from the garage to the marketplace, to enrich the lives of thousands or millions of people. As a former physicist, I know how difficult it is to gain new knowledge. And as a lawyer, I understand how difficult it is to take that new knowledge and negotiate your way through the minefield of development to get to the marketplace. So I and my fellow lawyers in the firm are really focused on providing practical advice to innovators, entrepreneurs, and their firms to help them throughout that process. And we have a network of very skilled professionals like my friend John Pennett, who provide services that are ancillary and complementary to those that we provide. You can reach us and see the free resources that we have available on our website at crowleylawllc.com. And just remember that we're here to help. Thanks. John, to get back to your focus, I have the good fortune of having some foreign technology companies that work with us to set up shop in the United States. And so, what sort of issues do companies who want to set up a footprint in the United States, what do they face from the accounting and tax standpoint?
So the greatest issue that they really face is the unknown. So we try to do things as confusingly as possible here in the US, right? So we've got 50 states. There are hundreds of taxing jurisdictions. They all have their own sets of rules and regulations and rates and things like that. So there's not a unified system that makes things easy, unlike EU VAT situations, which is kind of common across the entire EU. Corporate things are done in most countries at the corporate level, at the federal level. We have the federal level plus all of these other taxing jurisdictions. So the biggest thing that we have to try to help companies understand is how do we take something that is very complex and takes way too long to try to understand in detail, and turn it into a simple, easy to understand program, and to give people a sense of comfort that we'll be able to help them throughout their journey as they grow and they do different things in the US, and help them with those scenarios. So they have to face the same type of issues that any entrepreneurial entity would have to face. They have to decide the type of entity that they're going to be. They have to decide where they're going to domicile it. Most people suggest Delaware, C corporations wholly owned by their parent company. They then have to decide where they're going to register to do business. We're often asked the question, what's the most tax effective place for me to operate my technology business? And my response is, if I told you Alaska had the best tax rates, would you move your company to Alaska knowing that there's no customers or employees there? So the answer is, usually we're seeing people go to where the talent, where the customers are, where the business itself will be resonating. You then have to do all the registrations for those particular states. You have to set up systems to be able to pay your people, to
Right.
keep track of your books and records, to file your sales tax returns, and ultimately at the end of the year, file your income tax returns. So it's very confusing for a company, especially if they're going to start with just a few customers and a few employees here in the US. So the
Mhm.
biggest part of our program, which we use to help onboard companies here in the US with a soft landing, is a sense of confidence, connections, and comfort.
Well, the three C's, that
There you go.
is certainly very alliterative, John. Uh, with respect to tax issues, I know there's been a great deal of thought and discussion about the difference between employees and independent contractors. Can you give our audience a sense of why those issues arise and how companies can get caught up in unfortunate situations with the local taxing authorities?
Yep. Yep. So we see this especially with foreign companies where they'll look at their various options. So picture a company that has established operations somewhere in Europe, as an example, and they want to onboard one or two people here in the U.S. So probably the technically correct way to do that would be is to set up an entity, hire two employees, pay them as payrolled employees, pay all the taxes, et cetera, et cetera. That seems like a lot of work for some companies, especially if there's a great fear of the unknown. So we'll see a couple of other options come into play. So one is they may hire them as contractors. Okay. So that does not establish a US presence. They don't have to necessarily even set up a US entity. The risk there is that the Internal Revenue Service could come around and say, there's a 19-point checklist of whether you meet the definition of an independent contractor versus an employee. The answer is never 0 to 19 or 19 to 0. It's always somewhere in between.
Mhm.
But for a lot of people, you wind up having a person who's there most of the time. They take orders from you. They do what you tell them to do. They're probably an employee. So you've
Mhm.
taken a risk by classifying them as a contractor that they may be reclassified, and that subjects you to potential risk. The other thing that we see quite a bit now is the employers of record, the EORs, that come into play. So there, essentially, the person becomes an employee of another company, not your company. And that other company essentially does all the payrolling, and they just basically send you a bill. So I think a theoretician would tell you, well, they're still your employee, and therefore you have a presence. You should have an entity, and you should be paying income taxes. A practical person would say, well, they've got to put a lot of pieces together to figure that out. And if it's only one or two people, maybe that's a risk I'm willing to take. We certainly see that type of activity happening a lot more when a company has just one or two people in very diverse countries. So if you
Mhm.
had one, let's say, coder in Costa Rica or somewhere like that, is it worth it to set up an entity, or do you just follow one of these EOR type of an arrangements? There are certainly practical answers, and then there's the correct theoretical answers in all those cases. But
Right.
those are business decisions that people make based upon whether these are going to be sustained, long-term relationships, growing, or whether it's a one-off relationship for 6 months or something like that.
Right. So it sounds like some analysis is required. I recall when I was back at Johnson and Johnson, there was a general rule that a Johnson and Johnson as an employer would not employ someone in a role that they called an independent contractor for more than 12 months. They could only be there for 12 months. And then, as you mentioned, John, they would go to an employment company or a employer of record, which would then hire the person and basically second them to Johnson and Johnson to work for them. And that seems to be a popular way to get things done these days, with so many people in situations where they work remotely and can work remotely.
Yeah,
Another,
I think it's important to at least go into those decisions with your eyes wide open, right? So
Mhm.
understand, what your options are. If you are taking a risk, you should understand what that risk means, and then make an informed decision. So, people do take decisions like that based on a number of different factors. Being diligence ready. So, if a large investor was going to look at your company and do due diligence and hire, a prestigious law firm and accounting firm and investigatory firm to do due diligence, these questions will be asked for sure,
Mhm.
and they will challenge your assumptions for sure. So, if you go into those things, go into it with your eyes wide open and be able to understand what your exposures may be.
Super. And the penalties are not just payment of the back taxes, but there are also additional penalties and interest from the point in time that you should have paid the
Yep,
employee.
absolutely, absolutely.
So it can be a big number. I recall a number of years ago, Microsoft, a very large, sophisticated company, had to enter into a massive settlement with the IRS over their practice of overusing the designation of contractor for people who were basically at workstations next to people who were employees doing the same work as employees at the behest of a manager who was also an employee. And so it's very difficult, as you were saying, John, to argue from a practical standpoint that that person shouldn't be classified as an employee.
Right, right, and just think about like the recognition that like Uber's gotten and things like that in terms of their worker classification. So that's been in the popular news, even though it's like a not so popular accounting topic, but it made the popular news as well. So
Right. Well, that's another reason to have a firm that's experienced in these particular issues so that the company isn't caught up short, particularly since the laws vary from jurisdiction to jurisdiction. In California, for example, they have very strict rules about who can be classified as a contractor as opposed to an employee. And states on the East Coast similarly are looking at that as well, particularly as these governments seek more and more revenue to fill their coffers and spend on our behalf. Just at the thought of having foreign companies establishing a footprint in the United States, I know there are some tax advantages that go with that, and issues that come up are things like transfer pricing and licensing of intellectual property. Can you kind of give us a thumbnail sketch of how those things can be planned for to provide additional advantages to a foreign parent company?
yeah, so one of the questions that we have often with a company, so picture a technology company that has a U.S. Subsidiary and a U.S. customer. So the question really becomes is who owns the customer? So if the parent company back in let's just call it in the EU somewhere, if they own the customer, then they get the revenues. And since they're the parent company, they have all the costs. So the EU entity is whole. But then you say, okay, so then what does the US entity do? So the US entity just works to support the parent company. So it has no revenues. It has no chance to get revenues. All the revenues are owned by the EU. So really what it is it's a captive cost center acting on behalf of the EU parent company. So
Mhm.
those costs should be recharged back to the EU with a typically with some sort of a profit because it would only be fair to no entity would exist without a purpose of making a profit. So there should always be some sort of a profit built in. So they would recharge their costs back to the EU entity and have a small profit here in the US. The other alternative is that the U.S. entity owns the customer, in which case they have the revenue. But since all the costs and the development of the project were incurred in the EU, there's no cost of goods sold on the US books. So I've
Right.
got revenues with no costs. So I need to bring over the applicable cost of goods sold. So that would be a transfer price of the technology, the services. It could be a royalty on the license of a product. There's many, many different techniques to use. But the concept is I need to bring over a fair profit into the US. The bottom line of transfer pricing is that there are treaties between almost all major countries in the world. And the concept is that profit should be shared. So we shouldn't overload one country to the detriment of another. If the companies are working together, there should be some way that these things are shared together. So you have to go through a transfer pricing analysis. You have to figure out what functions are being done, where the customers reside, who's taking risk, who's making decisions, and then set a policy based upon that. Can be reviewed from time to time as business conditions change, but you really need to go through that analysis. At the very, very start of a company, sometimes we see people just use sort of a rule of thumb type of an approach, kind of let's see how the business model sticks, let's see if it grows,
Mhm.
and then if it does, we'll do something a little bit more formal. That's quite typically how we see things evolve over the course of time.
Super, John. Well, thank you so much for sharing those insights. Time has really flown by. If people would like to get in touch with you, how can they contact you?
So the best way to reach me is through the EisnerAmper website. So on there we have a list of all of our partners, and there's a link to my profile and my contact information. I'm also on LinkedIn, where you can find me there as well. That's usually the best way to find me, and or just go to various technology and startup conferences. I like to get to as many as I practically can. So obviously, not nearly all of them, but I try to get to the ones that I can.
Super, John. Well, John, thank you so much. And on behalf of our viewers, I want to thank you for sharing your expertise about these complicated topics. I would certainly encourage viewers to consider working with you, or at least finding a very skilled tax and accounting expert to work with you to set up and run your company so that you have the numbers that will keep you out of trouble. Thanks again, everybody, and we look forward to seeing you on our next session.
You've been tuning into the From Lab to Patient, Garage to Market podcast with your host, Phil Crowley. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, crowleylawllc.com. If you found this information helpful, please subscribe, like, leave a positive review, and share with others.